Hey, what's up guys, and welcome back to the channel. Today, we are going over the top 5 best stocks for February 2021. Make sure to watch until the end for the best stock on the list. And make sure to leave a like on the video and subscribe with notifications on. At number 5, we have NIO. This company is an electric vehicle company located in China. As of right now, NIO is trading at $56.67 with a 52-week low of $2.11 and a 52-week high of $66.99. Here's a clip explaining what's going to happen with NIO and the future of the stock.
First stock on my list is NIO, stock ticker NIO. This is an electric vehicle and battery company that's headquartered in China. Right now they have 4 very good looking cars on the market with more to come. So right now NIO is trading at $57.11 with a 52-week low of $2.11 and a 52-week high of $66.99. So right away you guys can see that this company has grown so much in the last year. If we take a look at their 1-year price chart, we can see that their stock price was hovering under $10 for a long time. And since June or July of 2020, that's when it really started to grow. We had a huge rush followed by a correction, and since then NIO has been trending upwards. This company has a market cap of $89.029 billion, and since they are not yet profitable, we do not have a PE ratio. Their earnings per share is negative $44.10, and they do not pay out a dividend. Looking at their valuation measures, we can see that they have a price to sales ratio of 34.86 and a price to book ratio of 77.97. As far as profitability, like I said, they are not yet profitable with a profit margin of negative 56.26% and also a negative return on equity of negative 116.34%. Their balance sheet, however, shows a very good current ratio of 2.42, which means that they have 2.42 times the current assets as current liabilities. And it's always interesting to see what analysts have to say. So on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, NIO is rated as a 2.4, meaning it is between a buy and a hold. The average analyst price target is $49.59, which is about 15% lower than the current price of $57.11.
At number 4, we have HIMS. HIMS is a telemedicine company that sells care products to men and women. This stock has potential because it's in the healthcare market and it has an opportunity to become something huge.
Now, the first company we're talking about is called HIMS, ticker symbol HIMS. Well, HIMS is a telehealth mail order product platform that connects consumers to their doctors and online pharmacy that ultimately allows them to get X, Y, and Z drugs. And the reason it's so attractive is because it's focused on the healthcare market, where we've seen disruption in retail, in transportation, in fintech, but not really any major disruptors in medicine. And that is where HIMS sits perfectly in this $4 trillion market opportunity. Now, of course, the market leader right now, or the most popular one, is probably Teladoc. It's a much bigger company. However, will you believe me if I say HIMS is actually growing at a much faster pace than Teladoc? For example, it took Teladoc 10 years to get 1 million consultations on their platform versus HIMS, it only took them 1 year to get 1 million consultations, and now it's even above 2 million consultations a year later. Obviously, Teladoc probably paved the way to get people more accustomed into telehealth, but regardless, HIMS is still a perfect contender given its unique proposition. Because HIMS is targeting a very unique market. For example, they're dabbling in ED and hair loss and stuff like this, like chronic conditions, which means that if the customer likes it, then they're going to have reoccurring revenue because you constantly need to take this every couple of days, weeks, or even months if you still want to retain the benefits of the medicine, where people might be too embarrassed to go into a face-to-face person doctor. But HIMS, on the other hand, you can actually connect with a physician remotely from the comfort of your own home, let the physician know about your conditions, order the medication, and have it shipped directly to your house.
Now at number 3, we have what I think is the best stock on the list, VGAC. This stock has crazy potential, and here's why. The VGAC stock is currently trading at $16.04. with a 52-week high of $18.16, but that's about to change soon. Another company, 23andMe, is merging with VGAC, and here's a clip explaining what's about to happen.
And I want you to think, when researching a company, you got to ask yourself, who is their biggest competitor and what sets them apart from that competitor? So we're talking about 23andMe, and currently 23andMe's biggest competitor is Ancestry.com, and Ancestry.com is currently dominating the game. However, Ancestry.com and 23andMe, let's be clear on this, let's get the facts out, they both laid people off in 2020. They both laid people off. However, what sets them apart, what sets 23andMe apart, is on January 27th, 23andMe launched a pandemic severity calculator that calculates a person's individual risk of being hospitalized due to the pandemic on a genetic level. What does that mean? That means they can read your DNA and they can tell how severe your body is going to react to it based off of your genes. Now that's absolutely crazy, and they ahead of the curve because none of their main competitors are offering this type of a service. Now, and on top of that, the global direct-to-consumer genetic testing market is expected to grow 18.4% this year up until 2027. Keep in mind, 18.4% is a lot. Why? Because the average on the stock market for the last 100 years, you already know, it's 10%. It's 10%. So that's basically double that. So now this is supposed to grow way faster than the average market is supposed to grow. But again, don't invest into a company that you don't understand and that you don't believe in. Because if it dips, you're not gonna buy the dip. And then you're gonna sell low and be right back here.
At number 2, we have Workhorse. Workhorse is a manufacturing company, and around this year, the stock will start rising rapidly. In the past 6 months, Workhorse has gone up 145%, and as of right now, is still growing by 14% every week.
A few months ago, we talked about how Workhorse was likely going to wake up towards the end of Q1 of 2021. I talked about how the risk of Workhorse is that a lot of its hype and trading is built around the potential USPS contract to replace their postal service vehicle, and that the constant delaying of said contract has caused some constant fluctuations in Workhorse's share price. But at the same time, when we started talking about Workhorse, we did not know how large of a priority the new Biden administration would make electrifying the federal fleet, which has meant that Workhorse has met our goal of waking up way ahead of schedule. And we discussed last night the sheer amount of demand that commercial electric vehicle companies are facing, and Workhorse is one of the biggest plays to actually benefit from said demand. Workhorse also has potential new contracts coming out on top of that towards the end of the quarter. But here's the deal, and this is why I want to reiterate Workhorse. You see, Workhorse is another one of those guys that's on Robinhood's naughty list. That means that Workhorse, a stock largely propped up by retail traders, will have restricted buying flow this week.
At number 1, we have CCIV and IPOE. As of right now, it is doing insane. The stock is growing at a rate of 0.75% every day, and it might surpass NIO in a few months. Also, IPOE will grow rapidly in the future as well. Here's a clip showing what's about to happen to these stocks.
Let's go ahead and start with Churchill Capital, CCIV. I do see this stock doing very well. One of the reports I read put it at, if you have a share at around $30 a share, that would value the company at about $45 billion. So I could see this going between 80 and 100 billion right out of the gates for an IPO. They are going to grow massively, in my opinion, over the next 5 to 10 years. So this stock has done well. For a few days. It popped up, and now it's been kind of retreating back down to a really nice level to buy into, and so I would have been all right with that one. But you can see this popped up and was down 12, and as it continues to grow, and then it's up, and so it's trending the right way, but it's kind of given back since the last pop. But I do expect others out there to see the same thing I do and look at this stock as a very long-term hold, and we'll go from there.